Hi guys, welcome to Chapter 10, the shareholders equity section of the balance sheet. I'm sorry I can't be there in person, but I do think this works in that we have some straight lecture to do. I need to establish some key vocabulary and terminology and concepts. So I'll do two shorter videos, no more than 12 minutes, to kind of do this lecture part. And then when we come back to class on Wednesday, we'll be doing some of the practice of the journal entries for this shareholders equity section of the balance sheet. I'll just remind you guys that we always are talking about the accounting equation. The assets came from somewhere. Either we borrowed the money, and that's a liability, or the owners, the shareholders, gave us the money, or we earned it in the past. That was retained earnings. So let's just talk about some of the terminology. We're going to expand our definition of the shareholders equity section. We're going to talk about paid in capital. This is capital paid in by our owners. Now one classification of paid in capital will be common stock. There will be others, but the one that we've been working with throughout the class of common stock, it's part of paid in capital. We're just going to be talking about this. We'll talk about par value, preferred shares, other parts of paid in capital. The retained earnings is, as we've been talking about all along, it's the amount of earnings that the company is keeping or retaining. We haven't distributed it back to our shareholders. And this new term is called treasury stock. This is stock that the company has repurchased from our shareholders. So here the shareholders gave us money, we gave them the stock. In treasury stock, this is a special classification of stock where we have actually bought or purchased those shares back from our shareholders. And we'll talk about why we would do this and how we would account for it. So let's start just with a reminder about common stock. I'll talk here about the first part of this, the stocks, common stocks, and shareholders. So one of the analogies that I often use is to imagine you and three of your friends decided to buy a house. So you each ponied up equal amounts of dollars from this. You each had one share of the house. You each owned 1/4 of the home. So in this case, there are 4 shares of the stock. You own the entire home. You might do something like hire a property manager to help you take care of that home or to make decisions about repairs. But the property manager is not the owner of the house. You're the owner of the house. You're expecting to make money from this house by maybe renting it out, maybe by having the value appreciate over time. But you are the owner. You own a 1/4 share of the house. Similarly, when we look at a larger organization like a corporation, we can imagine this corporation divided into, say, 100 pieces. And we have 100 shareholders, and they each own 1/100th of the company. Now, the reality is for many of our corporations, the numbers here are just bigger. If we talk about Intel Corporation is divided into 6 billion little pieces. So if you own a share of Intel Corporation, you own 1/6 billionth of the company. So why would you as a shareholder want to purchase stock in a company? Well, perhaps you'd like to participate in the growth of that company. Like you think, oh, semiconductors, those are good. I'd like to start a semiconductor company. It turns out that requires a lot of capital. I'll need millions of dollars to start a semiconductor company. I know, instead of starting my own company, I'll just buy part of another company. And that is what common stock is. You're buying or you're holding part of a corporation. So you as the shareholder are the owner of that stock. You're a partial owner of the company. As partial owner of the company, you're hoping that over time that company grows and that your share becomes more valuable. Other things that may happen is the company can decide to pay you dividends. They might say, well, we got a lot of earnings this term. Let's give some of that back to our shareholders. That's called dividends. It's similar, if you go back to the house analogy, your property manager would be like, yeah, we got more rent than we had in mortgage or other expenses. Do you guys want to reinvest that in the house, or do you want to take it out as income? And that's kind of the same thing that's happening here with dividends. As an owner, as an owner of a large corporation, you have voting rights. Now they're pretty limited. Like you don't get to vote as an owner of the Intel Corporation with a share of stock. You don't get to vote on, well, which semiconductor do we think they should make next. What you get to vote on is the managers of that business, particularly the board of directors. You get to hire and fire the board of directors. And for voting rights, for the most part, the way they work is if you have one share, you have one vote. If you have 100 shares, you get 100 votes. We're going to talk a little bit more about board of directors here in just the next slide. So it's a proportional authority to kind of express a choice. And there are some advisory votes and some other things that shareholders vote on. But primarily it's about hiring and firing the board of directors. We can go out and take a look at some of the how these stocks are traded. Let me just go out and pull a stock quote here is for Apple. So the market's not currently open. But we'll see that once Apple has issued shares, there is a secondary market where if I've purchased part of the company of Apple, I can sell it to somebody else. I don't have to just hold that. I could maybe sell it to another person in class. And the market exchange rate for that share of Apple stock right now is trading at about $123 per share. We can look at over time and see, how the pricing of this Apple share has changed over time. We're going to talk about stock splits and some other issues in companies. Here's the 5-year view of that stock. It turns out that Apple company was a really good stock to own over the 5-year time horizon. So we'll be going out and looking at some of the purchase of those stocks. We'll be looking at how we issue stocks the first time, and then also how they get exchanged in the marketplace and the secondary market over time. There are other kinds of stock. We've been talking about common stock. There are things called preferred stock. It's preferred with respect to dividends. That's it. It's preferred with respect to dividends. So preferred stock, if I say that I'm going to pay dividends, I have to pay my preferred stockholders dividends first before I can pay dividends to my common stock shareholders. We'll talk a little bit more about preferred stock when we look at issuing that stock. There are other classifications of stock. For example, Facebook has founder stock. And the deal with founder stock is for every share of stock, Mark Zuckerberg gets 10 votes. You get 1. For founder stock, he gets 10, which helps him to retain control of the company. So this is just kind of a quick overview of stock. If you have any further questions about it, make sure that you bring them up on Monday. We want to make sure everybody's kind of on board with what stock is and how it works. So let's talk about this organization chart for a minute. Here you are, you're the stockholder. You own the business. Doesn't feel that way sometime when you only have 1/6 billionth of it, but you own the business. Again, your voting rights give you the opportunity to hire and fire the board of directors. And the board of directors is the body that kind of oversees the management of the company, and they hire and fire the CEOs. And sometimes directly they will hire and fire some of the other chief financial officers, the other executives in the business, but a lot of times that's with the CEO. The board of directors is doing this. You own the company. The CEO does not own the company. The CEO might have shares in the company. They might also participate in the growth of the company. We're often working to try to tie these executive, their work to the success of the company. That's trying to align with the shareholders' value. But they don't own the company. You do. Right, so there's some things that we're going to talk about in terms of stages of equity financing. And this is important because when we get to the public offering, that's when we're going to do the accounting for this business. So, I like to assume that I'm Bill Gates. So let's assume that I'm Bill Gates. So first thing I'm going to do is as my nascent company is just, still just an idea, I'm going to raise money from my friends and family. I'm going to leverage my house. Eventually, I'll need more money. If the company is growing, I'll need more money than I can access. Even my banker's like, yeah, you're not you don't really have any cash flow yet. You seem kind of risky. We don't know about this whole computer thing. Who thinks that they're going to have computers in their house? That's crazy. So I'll go out to an angel investor often. So this is the beginning of my venture capital rounds. An angel investor is a wealthy investor who will pony up some dollars to take my business idea slightly farther. You might go out and look at an episode of Shark Tank if you haven't had exposure to this angel investors part of the world. I will note that it's a reality TV show, so it's made for television. It's not exactly that way, but it gives you the idea of what that angel investing might look like. They'll want part of the company. As a trade-off for giving you some additional investment dollars. Once you get through this first round of funding, maybe they'll give you several $1 million to start with. Eventually you'll need even more money, and that's when you might go to a venture capital firm. And a venture capital firm is just like a whole bunch of angel investors kind of all pooled together where you can get even more access to capital. They may provide some additional resources for you in terms of business expertise to get the company up and going. And then eventually, if this all works out, like this is a big funnel. Lots of companies wash out here at the beginning stages, and then a whole bunch more wash out in the angel investors. Only a few make it to venture capital. And the venture capital will invest in a lot of different companies, and only a few will make it to this initial public offering. An initial public offering is when they file all the paperwork with the Securities and Exchange Commission, and they take that stock out to the public, and you as an individual investor could go buy a share of Microsoft. And I'll just tell you this story as we're finishing up this first segment. If you purchased, the Microsoft stock, I think they went public in 1983, 1984, and they went public at $21 a share. So let's just assume that you invested $2,100 in purchasing Microsoft in 1983 or 84. If you held that stock until today, the stock would be worth over $2 million. But Microsoft was a successful company. If you'd invested those same dollars in a whole bunch of other companies, I don't know, the Pets R Us at that point, or Northern Lights, which is a great search engine, just you don't know about it because it went belly up. This was a very successful one, and so if you purchased on the IPO, you would have made a lot of money. This is why I like to pretend like I'm Bill Gates. Okay, so I'm going to wrap it here, and then we're going to go, and so take a pause. You stand up, walk around, and then log into the next one. All right, see you in just a couple minutes.